Most people think that trading is complicated. It requires indicators, it requires following the news, doing a bunch of fundamental analysis, may require multiple screens to look at all of these different charts. But what if I told you that my entire strategy, and if you have followed this channel, you already know that the strategy comes down to just two filters and only one confirmation. Hey everyone, welcome back to Quest for Alpha. Today, I want to answer a simple question. Can trading actually be this simple? And the answer is yes. It can be very simple, and I will demonstrate that. But I have to be honest that simple does not mean easy. Because while the process itself is pretty straightforward, what makes this hard is everything around it. There are emotions, there is patience, there is discipline, there is work-life balance, and the fact that the setups are never picture perfect. However, simplicity is what will get you to the profitability side. Because the simpler the strategy is, the less it is going to be prone to errors due to your ability to trade. So today, I'll walk you through exactly how simple my process is, and then I'll show you two confirmation setups that, based on my own data over the past few months, have had a very high win rate. Let's start with this. Everything I do starts with one question. Am I in an uptrend? So what do I do? I go to the monthly time chart, and first I look at the price action. Are we making higher highs and higher lows? And if the answer is yes, then I have already checked out the first filter. If that is not clear, this is why I have only one indicator that I use. And these are three different EMAs, 10, 100, and 200. They must be aligned on top of each other. That is just a confirmation that, yes, indeed, I'm in an uptrend and I can feel comfortable with establishing my first filter. If there is no alignment, then there is no trade. Then we look at filter number 2. Once I confirm the trend, I don't chase. I wait. I literally wait for the price to come down to a demand zone, to some sort of discount area. And this demand zone is defined in this illustration over here. And the way I do this is that I generally have some sort of bearish trend, and then there is a bullish explosive move. What typically happens is there is some bearish candles and then bullish candles being formed. These bullish candles must be strong, they must be consecutive, and each candle formed must be closing higher than the previous one. When that happens, and when this bullish trend have taken ideally a previous high, such as shown in this example, then that to me is a good demand zone. And that demand zone can then be used as a place, as a discount price, that when the price comes down again and touches that demand zone, I can move forward and I can claim that both my filter 1 and filter 2 are achieved, and I can then look for confirmation. That confirmation always happens on a lower time frame. In this case, that's going to be the daily chart. So I drop down to the daily time chart, I look at the price action, and I wait for the price to slow down. What generally happens is that a consolidation in this area, this is where I'm focusing in this area, and we can go on the next slide. What happens here is there is some sort of consolidation that happens. That consolidation needs to happen somewhere close to the 3 different EMAs. It cannot be way below them. It cannot be way above them. It needs to be somewhere close to them, or at least very close to where the 200 EMA is right over here. This is exactly what I talk about. Focus in this area for confirmations. It's really in this area over here. And then from here, I only take trades if I get one of these 2 different confirmations. The first one is what I call the double push. After a consolidation is formed, what I do is I wait for price to break out of the consolidation in this area over here. If this is a consolidation, this blue rectangle, and this is the green candle, this is basically the price breaking out of the consolidation and closing above. It also must close above the three different EMAs. It cannot be below it. If that occurs, then I wait for a second bullish candle to follow and to close above the previous bullish candle. And that is my confirmation. At that moment, I say that this move is real. I enter the trade and I place the stop loss right below the lowest point of the candle that broke out of that consolidation. The second method is what I call the snapback method. Generally, what happens is a price breaks out, but it doesn't follow through. Or maybe it has a bullish candle, but then it has a bearish candle or a candle that may have closed on the same level or below the breakout candle. And the price starts to retrace. This is what I called almost like a failed breakout. And the price in that case can do two things. It can either break down or it can reverse. If it tries to reverse, that's where I place a buy stop. I place the stop loss below the consolidation and I target 221. This one works pretty well because it very often traps a lot of people because most breakouts do fail. And this is why I rely on these double confirmation setups, the double push and the snapback. So what I would like to do now is I'd like to show you a real example on the charts. All right, so the first one that I'm going to show here, this is a live trade that's still going on. It is called the Trade Web Manager. You can easily see, and we are right now in the daily time chart, where the price action had come to the demand zone. There was a consolidation that happened right over here where all of the three different EMAs are. And then I waited for one candle to break out of there and for the second one to confirm, to follow through. Once that happens, an entry is placed and the stop loss comes right below that candle that broke out. This one is aiming for a 4.5 risk to reward. And the way I do that generally is I just place an entry. A stop loss goes below the consolidation and targeting 221. This is based on a previous entry method that I've talked a lot on this channel, and I use it as a frame of reference. And we can see that the price did come up, came down, but the candles never really close below that stop loss, and that kept me into this trade. And then the price had rebounded since, and it's on its way to that 4.5 risk to reward target. The second method that I talked about was the snapback method. This is where the price had consolidated here. There was a candle that broke out of that consolidation. There was actually another candle that followed through. However, it then failed because there was this candle that closed above. So this would have had already one losing trade here. However, you can see that that price action never failed and came below this consolidation. It actually came up, it snapped back. A buy stop would have been placed here, right at this level. A stop loss below the consolidation, targeting 221, and we can see that that target was achieved. So, going back to the question, can trading be simple? Yes, it really can. I mean, I just showed you two different methods that you could follow, that I follow on a daily basis, that I really like, and it does not really take any time here. Simplicity is what exposes your discipline, and there is no hiding behind complexity. There are no excuses. There is no over-analysis. It is just wait for the trend, wait for the demand zone to be hit, and then move on to the daily chart to look for a confirmation. One of these two would probably work very well. And then you just execute. The process is simple, but doing it consistently, that's where most people fail. And honestly, that is still something I'm working on every single day. If you found this useful, I'll keep sharing more of these setups and real trades as they develop. And as always, this is just my journey. It is me figuring this out one trade at a time. So if you have any questions, please feel free to leave them in the comment sections. See you all in the next one.